This is WealthBT, a podcast of BT correspondents. Welcome to WealthBT, a podcast of BT correspondents. Hosted by Genevieve Cua. In this episode, we break down what it takes to build a resilient portfolio. This episode is brought to you by Pictet Wealth Management.
How would you like a portfolio that rises along with the market, but doesn't fall as badly when the trend turns bearish? That sounds something like a holy grail of investments, but it's possible and doable. For investors with a long horizon, I believe it's more important to be mindful of the downside than be too concerned about getting the best upside. What we should aim for is a resilient portfolio. But what exactly is this? What types of assets can add resilience? In fact, we're bombarded daily by news and information on many themes: AI, climate change, war. How should you regard these themes? Are they just noise, or are they must-haves in your portfolio? Welcome to WealthBT, a podcast by BT correspondents. I'm your host, Genevieve Cua, wealth editor of the Business Times. Every week, my colleagues and I break down a business story that matters. Our guest today is Dong Chen, Chief Asia Strategist and Head of Asia Research for Pictet Wealth Management. Dong is also a Managing Director and works closely with Pictet's Investment Committee on asset allocation strategies. Thanks for joining us, Dong.
Thank you.
Let's start with a resilient portfolio. What exactly is this?
Well, building resilience into portfolio means making sure that the portfolio is built for the long term. Well, in a world where we see constant stream of news flows, in the financial markets, and to anybody, this can be overwhelming. It's very easy to lose sight of the big picture and get distracted by all those noises. So I think it's very important that to build resilience, it basically just means to dial down the noises and focus on the orderly investment process. The cornerstone of this process should always be strategic asset allocation, a long-term time horizon, active management, risk management, and diversifications are intrinsic to building effective portfolios.
Okay, let me just pick up there. When you say long-term, how long is long?
Well, in practice, every year we look at least a 10-year time horizon forward.
So you re-look at the themes over the next 10 years every year.
Yes.
So in your experience, advising clients, looking at portfolios, how would you describe the behavior of a resilient portfolio through ups and downs?
Well, a resilient portfolio doesn't mean that it does not have drawdowns. Drawdowns are inevitable. But the point here is that as long as you stick to your original strategy and you believe that your environment has not fundamentally changed, then your portfolio should be able to recover in a manner that is comfortable for the investors.
You talked about strategic asset allocation as an important element. What is this, and what factors would trigger changes in this?
Well, strategic asset allocation involves setting target allocation across many asset classes and based on several factors, including expected returns, risk tolerance, time horizon, and investors' investment objectives. And one needs to rebalance the portfolio periodically. By focusing on the long term, we can embed resilience into portfolios while addressing short-term noises through active management and risk management. So every year that we review our investment landscape over a 10-year horizon and adjust our strategy, identify key opportunities and risks, the strategic asset allocation do not change very often, right? Typically, we're going to keep it stable unless we identify there is a fundamental shift in our expectations and the environments.
So can you give an example of this fundamental shift?
For example, over the past few years, we've seen that the acceleration in changing climate change, right? And we think that with such changes, one has to take those changes into consideration and build that into one's portfolio.
When we talk about diversification, a lot of advisors actually bring in private market assets. How do these fit?
Well, in a traditional portfolio, people talk about the 60-40. That refers to 60% equity, 40% bonds. This is a great way of diversification, but this is traditional type of diversification, right? The reason that people increasingly look at private assets because according to our long-term projection, actually the traditional asset classes like equities and bonds, their expected returns will be much lower than 10 years before. For example, you take equity as example. The current valuation of equities are pretty high. And as a result, the expected return in the next 10 years probably will be significantly lower than we had before. So that's why to improve the overall performance of portfolio, we need to introduce private assets. And the private assets actually is a very large universe. It includes many different things. Infrastructure and hedge fund, we can have real estate, we can have commodities, a lot of other non-traditional type of asset class into the portfolio.
We've just been speaking with Dong Chen of Pictet Wealth Management. In a few moments, we'll be looking into how you can distinguish between a genuine trend that will have lasting impact on assets as opposed to mere distractions. And can you do it yourself or DIY your own resilient portfolio?
And now, back to WealthBT, brought to you by Pictet Wealth Management.
Welcome back. Dong, can you help us to understand, are there ways that can help investors to differentiate between a trend that we should participate in versus noise that is ultimately insignificant?
First of all, I have to say this is not easy. Of course, that's the kind of work that we try to do every day. And according to my understanding, a general long-term trend should be driven by long-term factors. So, for example, changing demographics, climate change, or shifting global geopolitical trends. Once those kind of trends start to set off, it usually will not change course or reverse during a short period of time. Take demographics, for example. Currently, we're seeing that China is experiencing this declining in population. Once that starts, usually probably lasts for at least 10 years or even longer. So when a trend is driven by factors like those, we tend to think those are long-term general trends.
So, Dong, given the many trends that have become apparent, which ones do you think are the most compelling and potentially the most profitable?
At this point, we're looking at several mega trends. Not necessarily you can, profit from it directly, but I think they're all very important in terms of determining how the world operates and how to have an impact on the investment outcome. So first of all, we are seeing the acceleration in geopolitics, right? So geopolitical division has widened with conflicts currently going on in Ukraine and also in Middle East. And rebuilding military capacity has become an urgent strategic goal for many countries, especially in Europe. And with the risk of diminished U.S. support for NATO added to that sense of urgency. So this rising geopolitical risk, we think it is a mega trend, at least in the foreseeable future. And second one is the acceleration in reindustrialization. So if you look at the recent history, over the past few decades, we see this very strong trend of industrial capacities moving out of the developed economies into developing economies, particularly into Asia. And this has actually created a lot of social issues and also created this confrontation between some developed countries and rising or emerging market, particularly between US and China. So during the COVID, and we're seeing this very clear trend of US want to, reindustrialize, moving production capacity back to their country and to a less extent in Europe as well. So this trend probably have very profound impact on both the DM and also on EM. Another trend we're seeing is acceleration in economic fragmentation. This is somewhat related to what we talk about changing geopolitical landscape. one typical phenomenon is reshuffling of global supply chains. Multinational companies are trying to diversify their supply chains away from China and move into other places. And so the previous trend of globalization probably is no longer an accurate description of the world that we live in. And we're seeing increasing fragmentation of the economy, of the world. Interestingly, you look at Asia, for example. Asia itself is developing into a integrated kind of economic zone with a lot of new production facilities coming up in a lot of countries other than just China. And lastly, I'd just like to mention a trend is acceleration in technology. Artificial intelligence has swiftly become a reality for many, including participants in the financial markets. And this increasingly accessible technology is spurring a new investment cycle and will profoundly change the world. So all those trends, I think, are very important to investment and also to the global economy going forward.
Can I pick up on some of these trends and how you translate it into the portfolio? Like, for example, tech. So that's been a big story in the last few months. And how do you be mindful of risks and volatility as well?
That's a very good question. So we've been looking at the rapid development of the tech sector very closely. And two things I think are very obvious. One, for some mega tech companies, especially in the US, their stock performance has been spectacular over the past 1 year or so. But at the same time, their valuation are also getting more and more expensive. So we need to focus on what exactly those companies are doing in this current artificial intelligence boom, right? So we're looking at how much they're investing and how much potentially they can actually get back from that kind of investment. So being selective in this process is very important, and be mindful of their valuation as well.
So that brings us to this issue or question of active management, and often read how many of the strategists are calling for active management at this time. Why do you think this is so? Why is this important?
Well, in the current environment, volatility actually is sometimes high, sometimes seems low, but it can change suddenly, right? So I think investors really need to be very selective based on country, sector, and also company characteristics. So being selective in itself means active management. You cannot stay idle and just stick to, one broad tool and hope it's going to achieve everything for you. Just give you one example. During the COVID-19 pandemic, you have the surge in prices, high inflation. So, when you have high inflation, companies actually can raise their prices fairly easily, and leading to actually, in some cases, greater margin. But after COVID, you started to see inflation abate everywhere. And that basically means the pricing power for companies actually is getting weaker. So you have to be able to, as an investor, to differentiate which companies actually have the pricing power and which ones do not. And so active management is really important.
So, Dong, how challenging is it for individuals to actually do it themselves, to build their own resilient portfolio?
This sounds easy, being selective, select the winner and ditch the losers. But in practice, it can be very difficult. I think one particular difficulty lies in the fact that humans have to face our own psychological problems, right? So humans tend to panic when you see market crash. And the human tend to fall into euphoria when you see market doing extremely well, and you get very happy and get very aggressive. And all these are enemies of long-term investment. So I think it's not impossible, but as an individual trying to achieve this, it requires a lot of hard work to overcome those psychological barriers. So an easier way probably is to resort to professional services.
Thank you for your insights, Dong. Appreciate you dropping in.
Thank you very much for having me.
A resilient portfolio is something to strive for and starts with a well-structured, strategic asset allocation. As we've heard, you can embed resilience into your investments by careful risk management and diversification, because ultimately, As it's often said, and I believe it's true, it's more important to limit your downside than to try for the highest returns. The upside will come as long as you stay invested and don't panic at the sudden dips in the market. I hope this episode helps you to evaluate your portfolio for resilience. BT Correspondence will be back next week with a new episode on transport, so do check it out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Genevieve Cua. As always, thank you for listening.
This episode of WealthBT was brought to you by Pictet Wealth Management. This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.